So hi again, everybody. As I mentioned in the previous presentation when we looked at consumption spending and investment spending, this part of the chapter that refers to the multiplier and the multiplier process, I tend to leave on its own because it's a very important part of our analysis. So it's another very important relationship in basically understanding how an economy works. And here we're looking at the relationship between changes in spending. So far we've looked at C and I, consumption spending plus investment spending, and associated changes in real GDP. So having established there's this link between money spent in the economy and output, real GDP, what happens when there's a change in spending in the economy? So we spend more or less money. How does that affect real GDP? And so we assume here that there's room in the economy to expand. Therefore, very simply, more money spent means higher GDP. If in the economy people go out and spend more money, then that's going to increase production. So the value of output must be going up too. Or if we cut back on how much money we spend, then production will fall. Therefore, the value of that production will go down. So more money spent in the economy means higher GDP, and less spending means a lower level of GDP. So if we have a change in spending in the economy, as I said, let's say an increase. There's an increase in spending. This will cause an increase in real GDP. But the increase in real GDP that we will observe will be by some amount greater or a multiple of that original initial increase in spending. And this is called the multiplier effect. So the multiplier effect tells us that GDP will rise by more than any increase in spending, or GDP will fall by any decrease in spending. So it's not a one-for-one effect, which at first you might think it would be. If I spend an extra $10 on goods and services produced in the United States, then why wouldn't the value of those goods and services also go up by $10? Well, we don't see that. And it's all because we have this spending chain that ripples through the economy. And so, as a result of this spending chain, we see this concept that the eventual change in real GDP will be different, be bigger than the original change in spending. So, to provide you with an example, imagine we have a firm A, and firm A decides to spend $100,000 on a new building, and that new building is built by firm B. So this is what we call investment spending. One firm purchasing goods or services from another firm. So right now, at this first stage of this process, firm A spending goes up by 100,000, and the output of firm B also increases by 100,000. So if we stop right now, spending has gone up by 100,000 and production has gone up by a value of 100,000. So the increase in spending is equal to the increase in real GDP. But the story hasn't ended. The story continues. And all because of that initial $100,000 increase by firm A. Because when firm B's output increases by $100,000, well, it's receiving that $100,000 from firm A. So the income to the owners of firm B and the workers will also go up by 100,000. Firm B receives the money, so that increases their income by the same amount, by $100,000. So what do they do with the $100,000? Well, what the theory suggests will happen next is that the firm won't keep, that is, save all of this money. They will go ahead and spend at least some portion of this increase in income. So for firm B, their income has gone up, and we think they'll spend some of that. Well, we've talked about this relationship before. This refers back to that marginal propensity to consume, the MPC. If you remember from the previous slides how we calculated the MPC, it was a change in consumption spending given a change in income. And it tells us the fraction of any change in income that is spent. So let's say right now in the economy the MPC is 0.75, which means given any change in income, we will spend 75% of that. So if firm B's income goes up by $100,000 and they spend 75% of that, then they'll turn around and spend $75,000 on other goods and services. So if the income of the owners and the workers at firm B goes up collectively by $100,000, we think they'll turn around and go and spend $75,000 of that increase in income on goods and services in the economy. Well, if they do that, that's increasing the output of another firm or a collection of firms by $75,000. So there's another increase in GDP. So now GDP's gone up by the original $100,000 plus this new $75,000 increase. So again, the story hasn't ended yet. That $75,000 increase in GDP creates a $75,000 increase in income. That is, the firms that receive that money, it increases their output, but again also increases their income. And so now income levels have gone up by an additional $75,000. And in turn, those recipients of that increase in income will then turn around and spend 75% of that $75,000, which is $56,250. And they spend that on other goods and services, which again increases GDP. So we got this chain reaction going on. And so this table summarizes what's happening. So these chain reactions are represented by these different spending rounds. So we can see in the very first spending round that $100,000, so that was the initial increase in spending by firm A on firm B. And this $100,000 spending caused an increase in GDP of $100,000. But as I mentioned, also increased the income of workers and owners at firm B by the same amount of $100,000. They then take their turn and spend 75% of that increase in income, which means we go to another spending round. Now we're increasing spending by an additional $75,000, which again increases GDP and income. So GDP and income rise by an additional $75,000. Add that to the original $100,000. So our total change in GDP is now $175,000. But at just that second spending round, that $75,000 creates an increase of $75,000 in income, which in turn will lead to more spending. 75% of that takes us to round 3, an additional $56,250 in spending. That creates more GDP in the economy at this amount, the $56,250 to the original increase from round 2. Now we have $231,000 and change. This whole process keeps going. At every round, we're spending more money, which increases output in the economy, which also increases income. And that change in income then creates a further level of spending in the next round. Note, each round of spending is less than the previous round. Technically, if the MPC is 0.75, each spending round is 75% of the previous one. So we have all of these spending rounds. They continue until the spending, this chain reaction of spending, dissipates. And so when that happens, we can add up, or we can track the total change in GDP, and it's going to give us this one big number. This big number here, this $400,000, is the total change in GDP that occurred because of this original $100,000 spending by firm A. So this is the initial change in spending, and it caused a much bigger change in real GDP. And this is called the multiplier effect. And again, when spending changes, real GDP will change by a multiple of that amount. And here we can see, if we compare these two numbers, real GDP changes by 4 times the initial change in spending. So the idea is, each round of spending generates more and more GDP. When all those chain reaction spending rounds are being completed, when the spending runs dry, the total increase in GDP is some excess of that original change in spending. And so this ripple effect through the economy is what we refer to as the multiplier effect. And the good news is that when we look at this, we don't have to create a table every time, looking at the original change in spending, then applying the MPC, and calculating the second round change in spending, and calculating the third round change of spending, and having to add all these numbers up. There's a nice shortcut, and the shortcut is using this variable called the multiplier. So what the multiplier is, it's the change in real GDP, the total change in real GDP divided by that original change in spending. So from our little example there, our multiplier would have the value of 4 because the change in GDP totaled $400,000. That original change in spending that kick-started the whole process was $100,000. So the $400,000 change in GDP divided by the $100,000 change in spending creates this multiplier with the value of 4. And the multiplier is very useful to us. So what does a multiplier of 4 means? It means in this economy, given any change in spending, real GDP will change by 4 times that amount. So again, that's what we saw in our table. The original increase in spending was $100,000. The resulting change in real GDP was $400,000, so 4 times the amount. So again, we don't have to worry ourselves with creating these tables every time. If we know the value of M for the multiplier, we can quite easily calculate the change in real GDP given any change in spending. Just reworking that formula, the change in GDP is equal to whatever the original change in spending is multiplied by the value of the multiplier. So in this example, change in spending was 100,000, the multiplier was 4, so the change in real GDP would be $400,000. And again, that's what we saw in the table. So the multiplier process is crucial for us to understanding how the economy reacts when there's a change in spending. Without the multiplier, we wouldn't know, given some change in spending, what will be the resulting change in real GDP. So, a couple of things to remember about the multiplier. While the initial change in spending, like in our example, is typically associated with investment spending, because as we mentioned earlier, investment spending is highly volatile. It changes considerably from year to year. It really doesn't matter which spending category is changing. It could be C, it could be I, it could be G, or it could be X. An extra $10 going into the economy is an extra $10. It doesn't matter whether that $10 was spent by households, the government, businesses, or through the foreign sector. The multiplier works the same irrespective of which level of spending has changed. And so also, in our example, we saw spending increase creating this multiple increase in real GDP. Well, that works in the other direction too. The multiplier works whether spending goes up or down. So had spending decreased, real GDP would have decreased by some multiple of that decrease in spending. So this whole process works because of the interconnectedness of the economy. This chain reaction of spending works through the economy in both directions. So this schematic here maybe help you understanding of what we're talking about. Because again, this is a very important point for us. So the table, if you notice at the top, I just pulled this straight out of the textbook. We have the initial change in income, which is caused by the initial change in spending. So as you can see, we have the increase in investment spending here, $5. Right, these are in billions, so that's $5 billion increase in investment spending from one company to another, which increases that next company's income by that amount. As one company spends $5 billion on another company's goods or services, that increases the income and the output of that second company by that $5 billion. And so if we increase income by $5 billion, we know some fraction of that is going to be spent. Like in our example, here we have the MPC of 0.75. So given any change in income, 75% of that will be spent. So if income goes up by $5 billion, we'll spend 75% of that, which is $3.75 billion. So that becomes our second round level of spending. And at the second round level of spending of 3.75, that increases the income of that next company by 3.75. So they'll turn around and they'll spend 75%, 2.81 billion of that 3.75 billion, which becomes our third round of spending, which will create a fourth round of spending and a fifth round of spending, and then all these subsequent rounds of spending until this whole process just peters out. And we'll have all these rounds of spending, all because of that original increase in investment spending of $5 billion. Again, here we notice the total change in income, or real GDP, is $20 billion, which again is this multiple of the original increase in spending. Again, the MPC helps us work through each round of spending and how much of the change in income is passed on to the next round spending. Down below, this diagram just replicates the same figures but shows it slightly differently. Again, this is our first round of spending. Here's the original change in investment spending of $5 billion. In the next round, that increases real GDP of the company by $5 billion, but they also take that $5 billion increase in income and spend again 75% of it, which is this additional $3.75 billion. So now the change in GDP, the $5 billion from the first round plus the $3.75 billion from the second round, gives us a change in GDP after round 2 of $8.75 billion. That in turn creates another $2.81 billion in round 3, so we need to add that in, plus the next round, plus the next round, plus all the subsequent rounds. And again, when we add up all those changes in real GDP, we get the amount of $20 billion. So, understanding the multiplier process, again, is very important to us, understanding how the economy works. And so, working through those examples there, it should be apparent that what's very important is the MPC. As income changes in each round of spending, how much gets passed on to the next round is going to be important in understanding what the eventual change in real GDP is. And that's all about that marginal propensity to consume, the MPC. So think for a moment about the relationship between the MPC and the multiplier. And if you think about it, then what we should see, the higher the value of the MPC, the greater will be the eventual change in real GDP. Because the higher the value of the MPC means more spending gets passed on in each individual round. A higher MPC is telling me that of the change in income, I'm going to spend more and more of that in the next round relative to a lower MPC. Conversely, if the MPC is a relatively small number, let's say 0.5, then for every change in income, we only take 50% of that and spend it in the next round. And then that will cause a change in income in the next round, and again, we only take 50% of that to change spending in the next round. So if the MPC is smaller, then little of the change in income is passed on. Instead, it's just saved. So the eventual change in real GDP will be a smaller number if the MPC is smaller. So the general rule is, the bigger the MPC, the bigger the value of this multiplier, the more GDP will change given a change in spending. So there's this clear relationship between the value of the multiplier and the MPC. Again, the bigger the MPC, the more spending that gets passed on at each spending round. The smaller the MPC, the less spending that gets passed on at each spending round. So the MPC is a critical variable in determining the size of the multiplier. So if we look here, we can see how this plays out. The multiplier can be calculated if we know the MPC or if we know the MPS. So if we know the MPC, we can calculate the multiplier as 1 divided by 1 minus the MPC. And if you remember the relationship between the MPC and the MPS, remembering that the MPC plus the MPS always equals the value 1, then 1 minus the MPC is the MPS. So these two calculations mean the same thing. 1 minus the MPC is the MPS, so 1 divided by the MPS must also give you the value of the multiplier. So from our earlier example, if the MPC is 0.75, and we can just plug that 0.75 into this calculation, so 1 divided by 1 minus 0.75 is 4. And again, 1 minus 0.75 here is 0.25. That is the MPS. So again, just 1 divided by the MPS of 0.25 will also give you 4. So if you know the MPC, well, by definition, you'll know the MPS. So either way, if you know one or the other, you can always calculate the size of the multiplier. But again, the bigger the MPC will give you a bigger multiplier value. For example, if the MPC is, let's say, 0.8, so plug 0.8 in. Well, 1 divided by 1 minus 0.8. 1 minus 0.8 is 0.2, and 0.2 goes into 1 5 times. So when the MPC is 0.8, the multiplier will be 5. So the bigger the MPC, the bigger the multiplier. And here we have some other examples of MPCs and multipliers. So here's the two we just did. When the MPC is 0.5, multiply is 4. MPC is 0.8, the multiplier is 5. The MPC is 0.9. So 1 divided by 1 minus 0.9 will give you 10. So again, the bigger the MPC, the bigger the multiplier. So that's a standard textbook definition of a multiplier and how we calculate it, and we'll see again when we look at the aggregate expenditures model how we really use it. But what is the actual multiplier effect in the United States? So typically the actual multiplier in the US is estimated to be between about 2.5 and 0, where 0 is clearly very much on the low side and 2.5 would be, I would suggest, very much on the high side. Typically the multipliers I've seen and used, multiplying value about 1.5 is I would say average. So any change in spending would cause a change in real GDP of a magnitude of 1.5 that amount. So these multipliers are typically smaller than the ones we'll use in our examples, because in reality there are other leakages from the economy that we have to take into consideration. For example, when there's a change in income, well, part of that is taxed, and that leaves our spending chain. So we might also have part of that income going towards an import. Well, an import doesn't have any effect on domestic GDP. If I go and spend money on a good made in a foreign country, then that spending flow, as we call it, leaks from the economy, because it's going from the US economy to a different economy, and that has no effect on the United States' real GDP. So imports and taxes reduce the flow of money that go back into our spending chain domestically, so it reduces the overall multiplier effect. But that's probably one step more complicated than we need to make it to be, so we'll just assume that away and we'll look at the multiplier effect the way we've just described it. Also, if the economy is closer to full employment, then increases in spending can drive up prices, which we know is inflation. And so at higher prices, any given amount of spending will buy less real output. So that would mitigate the multiplier effect. And so the multiplier effect is very real. We use textbook kind of theory definitions here, but the multiplier effect is very real and used in economic input-output modeling, which typically looks at a regional economy and looks at how a business or other entity impacts the regional economy. So what economic contribution does one business or one local entity have on the regional economy? And we would use the multiplier process to help us understand when one business's spending filters through the economy, would use the multiplier effect to understand what the total effect would be, the total change in that region's gross domestic product.